Hi everyone, Mike Rosendahl here with PCE Investment Bankers. Today we're tackling a crucial topic for M&A transactions, tax structures. Specifically, we'll compare two options called F-Reorganizations and 338(h)(10) elections. By understanding these, you can make informed decisions about your M&A deal and potentially save big on taxes. First, let's talk about 338(h)(10) elections. Think of it as a strategic tool in the tax world. It lets you treat a stock sale almost like an asset sale for tax purposes. Why does this matter? For buyers, it's a chance to reduce future taxes through what's known as a step up in the tax basis of the acquired assets. However, for sellers, especially those in S corporations or LLCs, this could mean facing higher taxes. But there's a catch. This option comes with limitations. First, it only works for S corporations. Second, both buyer and seller have to agree to make the election, and the buyer needs to acquire at least 80% of the company. Finally, sellers might have to pay taxes on all their gains, even if they're not selling everything. It's like selling your house, even if you only sell half and you pay taxes on the full value. Who in their right mind would want to do that? Now let's talk about an F-Reorganization. This is where flexibility really comes into play. An F-Reorganization allows a company to change its legal structure without altering its day-to-day operations. This is a game changer for many M&A transactions. For buyers, the benefits are clear. You can step up the tax basis in the company's assets even if you acquire less than 80% of the equity. This means future tax savings without needing to buy out the entire company. And for sellers, F-Reorganizations could be more tax efficient for you too. If you choose to retain some ownership post-transaction, you can defer taxes on that portion. Plus, there's no need to sell a majority stake, giving you more control over your exit strategy. Let's put this into real-world context, especially when it comes to deals involving less than 80% of a company's equity, a common scenario in transactions with private equity groups. In these deals, private equity investors often opt for what's known as an equity rollover. This means that the selling shareholders, perhaps like you, keep a stake in the company even after the sale. Now, under the 338(h)(10) election, there's a cap on the rollover. Sellers can only retain up to 20% of their pre-deal equity. But with an F-Reorganization, things get more flexible. Sellers can roll over more than this 20% threshold, deferring taxes on the rolled over portion. This not only benefits sellers, but also helps buyers. How does this happen? They still get to enjoy the step-up in basis of the company's assets, which can lead to future tax savings. Here's where it gets even more interesting. Let's say there's a deal where an LLC wants to buy an S corporation. This scenario is pretty common with private equity groups looking to acquire privately owned companies. Due to specific ownership rules, private equity groups can't directly own S corporations. This is where the magic of an F-Reorganization comes in, allowing the transition to happen smoothly while ending up with an LLC owning the assets, which is a preferred structure in many of these deals. To delve deeper into how this works, don't forget to check out our blog. The link is right in the video description, where we break down the concepts with easy to understand examples and graphics. Each M&A deal is unique, and navigating the complexities of F-Reorganizations and 338(h)(10) elections requires a tailored approach. That's where expertise and experience matter. At PCE Investment Bankers, we're here to guide you through these intricate decisions to find the best fit for your specific transaction. Thanks again for tuning in. Don't forget to like and subscribe for more insights on making your M&A transactions successful.